So without further ado, let me introduce you to Rolake. Rolake?
Thank you, Eric. Ladies and gentlemen, welcome. I'm going to be starting this presentation by giving a broad overview as what I see are the main opportunities and the outlook for the energy and extractives industry. Although I'm primarily a hydrocarbons expert, my portfolio also includes energy, power, and some other extractive resources, such as the mining sector. I don't know if we've talked about this today, but one of the things I thought I'd start with is the real story for West Africa is investing in the demand story for the region. And I thought it would just be interesting to remind us of why this region, I don't know how much you can see from there, is particularly important. I think the population story is obviously an important one. Around 30% of sub-Saharan Africa's population. It was described during the colonial period as a bit of an El Dorado region in terms of its resource base. Another interesting fact is the West Africans who actually fought for independence, those who were at least 20-year-old in 1960, currently constitute only 3% of the population. So it is a young population. By 2050, West Africa will host more people than Northern America, and as almost as many people as Latin America and Europe as well. The other thing that I think is particularly interesting is this constant move towards cities and increasing urbanization of the region, which many people will see as a demographic dividend, and certainly for investors. But I think, except there is a real manufacturing base, whilst we can talk about resources, access to jobs and wealth creation are going to be critical. And there is one person who bears the major burden of that, which is this guy here on the right, Nigeria's president, more than half the region's population. So I just thought that would be an interesting context setter for the presentation. Moving swiftly then to the hydrocarbons industry, looking at what's happening in the region. This thing is quite slow. Oil and gas. I'm going to be focusing on the ECOWAS region. I know some of us define West Africa in a very broad sense, so I'm not necessarily looking at the Gulf of Guinea or the western coast of Africa. I'm looking at primarily the 15 countries that comprise the ECOWAS region. Main oil production opportunities are in Nigeria. The region produces around 2.5 million barrels per day, now followed by Ghana, which is producing around 100,000 barrels of crude oil a day. Then Côte d'Ivoire, around 40,000 barrels a day, and Niger at 20,000 barrels a day. But what is even more interesting about this region is that almost every part of the West African coast is currently witnessing some sort of exploration activity or the other. Actually, there is no single country in core West Africa, with the exception of Burkina Faso, which doesn't have oil explorers on its borders. As recently as 2 weeks ago, the Republic of Benin found an estimated 87 million barrels of crude oil and could start producing around 7,000 barrels over the next 5 to 6 years. Another interesting trend we're seeing for the hydrocarbon sector in the West Africa region is the growth of indigenous and small junior oil and gas explorers. So exploration in the West Africa region is no longer the preserve of just the international oil majors, and indeed a lot of them are actually divesting away from parts of the onshore region in Nigeria, for instance, to parts of the offshore and the deep water. The Nigerian market, as we know, there's been around 5 billion worth of asset divestments in that market. What is even more interesting is that frontier markets like Ghana and Côte d'Ivoire will also be witnessing a greater move towards local content, which will require partnerships between international investors and local investors. The other big industry that is likely to kick off, and Ghana is a particularly exciting place for this now at the moment, is the oil field service industry. Drilling and rig services in West Africa are estimated to grow by around 7% to 2015. We've actually estimated that annual oil field service needs in a frontier market like Ghana will come to around 5 billion annually. And so we're talking about a range of services, both from high-end services to fleet, rig management, health and safety. And these are things that we certainly see that the local content development and legislation will help ushering. All of the big four global oil service companies are operating in West Africa, Baker Hughes, Transocean, but with the advent of local content legislation, what we'll see is a growing contract market for small and medium-sized enterprises and other local investors. This is really interesting because often we talk about the consumer story in Africa, but what is actually underpinning all of this is the energy consumer story. West Africa is a huge oil consumption region. You'll see there on the graph in the red circle, almost 600,000 barrels a day, around 50% of which is consumed just in one country. But on the flip side is that per capita consumption of energy in the region is extremely low when you compare it to other parts of the sub-Saharan Africa sub-region. So look at Ghana at 265 kilowatt per hour, compare that to Zimbabwe, Zambia. The comparison, the gap is indeed wide. So with the demand for consumer services will also come the growth and demand for energy. And this then presents another really interesting opportunity, which is downstream and trading opportunities. It's a market that's not often looked at, but I think when we're talking about the diaspora market, beyond looking at the big mega billion, multi-million dollar oil and gas projects, I think this is a really important opportunity, and you'll see later when I talk about logistics. Of course, the biggest consumption markets there are Nigeria, Ghana, Senegal, Cote d'Ivoire, and Benin. But gasoline and diesel will witness the highest growth rates, driven primarily by transportation, consumerism, and as well as industry, mining and oil and gas. And the new growth area, LPG. Ghana is one of the fastest growing LPG consumption markets. We've certainly seen investors interested in investing in storage and distribution activities. And then put that in the wider context. This is what is happening in the downstream sector. So the Ivory Coast actually controls much of West Africa's oil trade because it is the most prolific refiner of oil products, despite Nigeria actually being the largest producer. The largest refiner is actually Cote d'Ivoire. So there's a real market there to be captured. And with the advent of new oil exploration and production hubs in places like Ghana and further afield, we certainly see a big growth in the logistics, trading, and distribution business in that region. But then what is important is West Africa is obviously dependent on hydrocarbons as a huge part of the energy mix. But there's clearly one piece of infrastructure that's missing, and that's a huge problem. If you look across all these countries that I've selected here, you'll see that oil and natural gas account for the bulk of the region's actual production. And when you compare West Africa to the other sub-Saharan Africa regions, own generation, which is generation through diesel power generators, actually constitute 51% of the share in West Africa compared to the other markets. So you really start to see the size of the opportunity in West Africa. And around 17% of that own generation, which is 51%, is actually diesel-based. This is obviously clearly not a sustainable picture. What needs to happen? Well, the region needs to add around 100 gigawatt of capacity between now and 2030 to meet demand, and this will require additions yearly of around 3 gigawatt. Key challenge is electrification and access to energy, and I know one of our panelists here will be talking about off-grid solutions and renewable energy. The other opportunity is to boost the regional infrastructure and electricity trading between countries in West Africa. That hasn't happened as fast as we'd like to see it happen. It requires investment in infrastructure. The key obstacles for investing in West Africa's power market really is regulation and pricing and competitivity, as well as the weak transmission infrastructure. But there is hope. There is change going on. Now we're seeing, for the very first time in my entire lifetime, growing up in Nigeria, I've actually seen power companies handed over to private investors. I think we can certainly see that as a major milestone. But it's not just Nigeria that's seeing this improvement and movement and reform. Ghana, for instance, is moving towards cost recovery, as is Cote d'Ivoire. Renewable energy, West Africa lags behind the rest of the continent. East Africa is actually the main renewable energy hub, but you will see that the green bar there, which is the highest bar for West Africa, is solar power, photovoltaic, and we really see that as a big opportunity for the region. We, as a bank, have actually been involved in financing various projects, biofuel projects and bagasse projects in parts of the West Africa sub-region, but we think further growth on this is going to depend on cost reduction as well as regulation. Finally, I'm getting to the end now, mining sector. West Africa, for me, there are lots of minerals. I can't go through all of them, we don't have time, but I just wanted to quantify some big ones. Iron ore opportunities are perhaps West Africa has some of the last remaining iron ore frontiers globally, and why this is particularly attractive: low cost iron ore, which is a purer grade and therefore easier to develop, but often the bulk of that is found in Guinea, which has had problems around political risk. But having said that, there is now an increasing move by the government to move towards transparency, despite some of the headwinds we've seen on the governance front before. The other region that's particularly interesting is Senegal's Falémé region. It should actually be Senegal, not Mali, excuse me. Senegal's iron ore region, which is also one of the most promising regions. And believe it or not, even countries like Nigeria do have iron ore deposits which haven't been actualized. And then the final slide here is gold. The gold sector is also booming in West Africa. Burkina Faso and Ghana are clearly some of the, Ghana is the biggest producer, but Burkina Faso does have an even bigger amount of deposits which haven't been fully commercialized. But I think one particular trend, and perhaps sort of to round off the discussion, one particular trend we're going to be seeing a lot more is the gradual move towards local refining and processing, pretty much the same way we're seeing in Botswana, with De Beers relocating its diamond processing hub to Gaborone. I think one of the things that we're going to be seeing more is governments requiring investment in local processing. And if anything, for extractive projects, I think this is where the real value add from small investors can really come in. And on that note, I'm going to round it off there. There will be time for questions. What I'd like to do now is really move to the panel discussion, and we've got quite a wide variety of discussions. The first panelist that we have speaking is Jordan Wan of Timber Resources, who have gold interests in Liberia in West Africa, and he's going to be talking for around 20 minutes. Timber Resources have been operating since 2010 in Liberia, and they have a huge commitment to social and environmental responsibility in that country, and they mostly focus on small scale and small timeline projects, and they're anticipating production over the next 6 to 12 months, productions within the 6 to 12 month phase. So Jordan, would you like to take the podium? Thank you.
Thank you. Thank you very much, everybody. Welcome to Timber Resources presentation. Today we'll have two speakers. I'll have Richard later as my Chief Operating Officer be taking care of part of the technical part of how our alluvial mining process is. So we're here, obviously, to show you our alluvial mining project in Liberia. I'm Jordan Wang, president of Timber Resources. We've been in Liberia on the ground for a little bit over 3 years, and it's been a fascinating, really fascinating journey. We live, breathe, and eat in Liberia. So we'll want to raise $15 million to start our gold production, which after the financing close will probably be around 6 to 12 months. And we're happy for you to join our project. And this will be our story. Video, please. Thank you. I guess we're getting there pretty soon. Thank you. Very special and great day for all of us at Bomo Oda and Bomo Johnson.
For our brother from Canada,
Our brother, Canada,
the work for our maize,
you bring your now.
we decide to come to Labrador for investment. For the Dama Canada,
And here is Jordan Wing.
Jordan Wing.
You may you more going to say, now I don't as one I do able.
And right here is Mr. Jordan Wing.
Cancel, right here.
And this is all men.
Yeah.
This is not machine.
No.
They dig down and do it all by hand. How many years have they been working here?
They just started this year.
Just started this year.
Yeah.
So now I'll hand over our presentation over to Richard, the guy that you see in the video that was cleaning the windshield at the back.
Hey, take that with you. Hi, my name is Richard Fesick. I'm the Chief Operating Officer of Timber Resources Limited. Our plan is to start a commercial alluvial mining operation in a highly profitable area of Liberia, West Africa. Let me give you a little background on myself and how it all began. I was born in Canada, in Northern Ontario, and been putting mines into production for the past 3 decades. In 1983, I worked on a mine outside of Phoenix, Arizona called the Mammoth and helped to put it into production. I was then asked to go to the northern Yukon to help put a mine in production there. These were hard rocks. I then ended up in Costa Rica. In Costa Rica, we put an alluvial mining project into being. It was quite successful after a short period of time and lived on after I left. I worked for public companies for over 40 years in some form of capacity as a director, and in that I got immersed into how the operations of stock market and mining and all that proceeded and worked out. A couple of companies I worked for with General Energy and Gold Cup Resources, to name a few. During my tenure with mining companies, we also got involved and I was immersed into oil and gas for a period of time. And we did help to put in some smaller oil and gas projects into play. In the 1990s, I was fortunate, like I said, to design an alluvial gold operation in Costa Rica, and it was successful. And this is where I started to immerse myself in getting to understand the alluvial mining beam. During the last 3 years, we founded Timbo Resources to seek an alluvial gold property in Liberia with a new approach to bringing this into play. Slide 4, Jordan. During the closing of the initial funding, we will be in production in 6 to 12 months. And 1 month after production, we will be in a constant cash flow. No more financings will be required after that. As a triple bottom line company, we can be self-sustaining financially and provide benefits to the surrounding communities by assisting with building schools, health facilities, and other infrastructure. Alluvial mining is the most misunderstood form of mining. The misconceptions are built from many years by different views at the procedures of placer mining. Most are top-heavy with intensive labor and equipment. It is also a scourge on the environment, as most placer projects dig up the working area. They carry the material and gravels to another place on site by truck and leave large waste piles as far distance from where they were removed. Another truck will transport the material to another location on site for another phase of the processing. Very rarely is the environment ever replaced to its original state. Our design of alluvial mining is different, as trucks use a lot of fuel and leak oil and fuel itself. They contaminate the environment and working area. By eliminating trucking, it means no trucks, no drivers, no fuel. Because the ground oftentimes gets saturated with water, rubber-tired vehicles find it difficult to move around. As a result, they cause more downtime and repairs. Eliminating trucking, therefore, is a major cost saver. Therefore, all of our equipment will be on tracks. Complete processing of the material will move with the working area. We have been in Liberia for 3 years, and I have personally been conducting prospecting and testing in all areas of the country. There are areas in Liberia which are rich for alluvial mining. Some of these areas are still virgin. The war has taken a toll on the people. To understand the people, you must be part of them and work with them. These people want to make a living for their families. It's their land, so let's work with them. We hire Liberians, mostly people in the area, as they know their land much better than we do. Most artisans only dig pits out of desperation. Most hardly make a dollar and would actually prefer to work for somebody else. These artisans, once we get to know them, would provide us with a lot of valuable information. I have in many cases taught artisans how to mine more efficiently and become more successful in their endeavors. The friendly exchange has helped us to gain tremendous proper results that we require and information on a property area. For them, it helps them gainfully profit-wise on their own endeavors. The Liberian government wants companies rather than artisans because of the tax revenue they will receive. Geological information can be more sustainable and infrastructure will be built. Many multi-billion-dollar corporations, multinational companies, including Firestone, Chevron, BHP Billiton, and ArcelorMittal have already vested heavily in Liberia for its rich natural resources. The government of Liberia supports international investments and the extractive industry. China, India, and Brazil have invested heavily in Africa. These figures are in 2010. This is a view of the capital city, Monrovia, in Liberia. It is the hub of Liberia and the home to most government offices. These are two current projects we have. The red star is the Bomi project and the blue star is the Tuma project. The Boma project consists of 15,000 hectares. This area is very rich in gold and diamonds. It is very close to major roads for easy access. All testing results average 0.5 grams per ton. We will acquire additional licensing along the river to extend the lifespan of this project. More recon and prospecting trips are underway. Since we are in the alluvial mining business, most targets are river bottoms and river banks. Whoops, I think I'm missing a page here. No. Are along river banks. These are some of the programs we ran. All testing locations along the rivers and river banks and delta areas are strategically picked out for our program. The second project is the Tuma project. The Tuma project is unique and a prize for placer mining. It is 640 square kilometers of property with several hard rock mines. In the past number of years, one nugget of gold of over $1 million was found, and a couple that were smaller than that, but close to $1 million. There are 4 river channels in this area: the Mane, the Ba, and the Manu, all containing gold and all dumping into the Tuma River. The Tuma is a strong gold producer because of what is fed into it. The source of gold is mostly from the Po Mountain Range and the Buluba Range to the south. That middle mountain range is the Buluba. The Tuma River has been mined for the last 5 years by artisans on a large scale. 20 years ago, there was lots of shallow alluvial mining operations going on to recover gold in the area of Bapalu and Lofa. The war put an end to such activities and never returned back again until recently. One pit of 25 meters by 25 meters, a testing pit that is, we produced 3 kilos of gold. We have 10 kilometers of gold-rich Tuma River amongst many other areas under the Tuma project. A new access road built by the government of Liberia will make bringing equipment and supplies to the Tuma project more economical. Timbo Resources plans to build a 5-acre facility camp for storage and a workshop. This is on high ground and where drainage would be no problem. It also has access to the Tuma, the Ba, the Mane, and other tributaries that we will work on over time. Accessibility is also good from the new road from Monrovia. It also has lots of space on the higher ground to put an airstrip. Our unique process will be handled by excavator, wash plant, and concentrators to recover 95+% of the gold. The concentrate from here is then taken to a final finishing room for final processing. The gold is now poured into dory bars and stamped. Our own airplane will fly this to Roberts International Airport, where the government will weigh it and taxes will be paid accordingly. After the mining phase of this area, a Caterpillar dozer will level the gravel piles and proceed to replace the overburden. This ground is now ready for farming and will be returned to the local peoples. Seeing is believing. Here is a view of how our operation will flow. Most of our funding will be equipment purchases. All equipment will be brand new from Caterpillar due to hours, the workload, and the working environment that is required by our project. Buying new is a better strategy than buying used. Production suspended due to equipment failure will cost the company more than the additional cost of purchasing brand new. This process of mining can run through 10,000 tons per day. We have obtained an average of 0.5 grams per ton by way of past pit testing. By immobilizing our equipment operation like this, it is highly profitable right from the beginning. As an investment proposal, our investment proposal is like this. For $15 million US, in return, Timber Resources will offer two options for funding. The short option, a 49% profit sharing until payment reaches double the amount of your initial investment. If our project starts in 6 months after funding, the investment can be doubled in less than 3 years. The long term, a 49% profit sharing until your initial capital of the $15 million would be replaced, and then an equity of 15% stake for the life of the project thereafter. Our preliminary estimates, the lifespan of this project for 15 years. In total, a return on your investment will be around $56 million for the $15 million invested. All calculations are from a $35 a gram calculation. Thank you. This concludes our presentation, but I want to leave you with a thought. Hard rock mining takes 5 to 10 years of work and hundreds of millions of dollars before any production returns. By the time the project is ready to go, you will need another hundreds of millions of dollars to buy a mill and install it on the property so that you can start to see your money come back. In alluvial mining, you define the area, you get the licenses, you buy the equipment, and within 6 to 12 months, production can be started. Each month after, cash flow and profits are constant as the overhead is low. No more financings will ever again be needed. The cost of putting a project like this into production is a mere $15 million. At that rate, how can you lose? For interested parties, if you're an institutional investor, please contact us directly or contact HomeString's representatives. Thank you very much.
Thank you very much, Richard. I don't know whether you or Jordan are going to sit on the panel. Which one of you is going to sit on the panel? Okay. All right, thanks very much. We're going to hear a bit more later during the discussion. Now, I'd like to welcome Randolph Rodriguez, Head of M&A and Financial Advisory at Stanbic Bank, Ghana, and who's going to be presenting some of the work they're doing in the oil and gas space. Thank you.
Hi, good afternoon, everyone. My name is Randolph Rodriguez. I run M&A and financial advisory at Stanbic Bank in Ghana. And for clarity of anyone, Stanbic Bank is the same as Standard Bank. We trade under both names depending on the geography we're in. So I'm going to be talking a bit about power and oil and gas. The key thing to note is it's impossible to talk about one without the other, particularly in Ghana. And the reason will be, where should I point this? Sorry. Okay, so just quickly to give you the lay of the land of power in Ghana, right? There's a couple of sources of feedstock that flow into our various power producing entities. We rely heavily on hydro, which is water, which is what Ghana is known for the Volta Dam. We're also increasingly relying on gas, and that's why oil and gas is obviously very closely tied into the power sector. There are a couple of power generation sources. VRA is primarily responsible for power generation in Ghana. Increasingly, independent power plants are becoming a growing source of power for Ghana, and that's where there's likely to be meaningful opportunities for individuals and institutions to put capital to work in the Ghana market. On the power distribution side, besides ECG and NEDCO cover the breadth of retail consumption of power in Ghana, a large source of utilization of power is the mines. So whether it's the gold mines or other natural resources, they have direct relationships with the power sector due to their large power uses. The key thing to note is with demand in Ghana for power is growing. Unfortunately, there hasn't been equivalent growth in supply, and so the country currently is heavily undersupplied in terms of their power supply. And in addition to the domestic supply, we also export power to a couple of our neighboring countries. So without significantly increasing the stock of power supply, there's going to be meaningful challenges going forward. We've had several periods particularly last year and this year when there were significant dearths of power supply, and so manufacturing was significantly hurt. There were periodic shutdowns in power on an almost daily basis, and that is certainly something the government is keen to correct. One of the key drivers for power supply is availability of fuel. So if you're doing hydro, obviously you need the range, you need the water to flow. If you're relying on thermal power, which Ghana is increasingly doing, you have to be able to supply light crude oil. And many people think of Ghana now as an oil-producing nation. And you'd expect that we would no longer have challenges sourcing crude to supply our thermal plants. However, we have to source the capital to purchase these significant volumes of thermal power, of petroleum, to support these producing facilities. One new development in the market is the importing of liquid natural gas. That's another area where we're seeing the need to, it's a lot cheaper for us to import liquid natural gas and then regas it to use on the various processing plants rather than to use the liquid crude oil that's actually from our own oil fields. To highlight sort of the position we're in, this just highlights the existing installed capacity. And you'll see that we're somewhere about 2.5 to 2,700 megawatts installed capacity. The goal for the country is to increase it to about 5,000 by 2015 and then further double it by 2017. Most of that, which you'll see, the installed capacity naturally has been driven largely by the government. Historically, most infrastructure has been sourced from public coffers. In order to sustain the level of development we require to meet the needs in the country, there's going to be a lot more involvement from the private sector. And so looking at the ongoing additions to the installed base, while we have 2,680 from the previous slide, we're looking at double that on the additions, of which you'll see majority of it is in the independent power plant pool. The way these are increasingly working is whether it's individuals or institutions with capital are partnering with direct off-takers, so be it a mine, a manufacturing facility, or a pool of manufacturers, and setting up power plants on their facilities to cater directly to their needs. And the capital spend obviously is a lot less than constructing a dam per se, and also because you have guaranteed offtake from whoever your partner is, you're able to lock in pretty attractive returns from the construction of IPPs. And so this, the point is not to dwell on the power sector, but just to highlight that there is that key opportunity to focus on. I'm going to spend a bit more time on specifically oil and gas, and with notwithstanding, I think it's been much ado about nothing, I like to put it, in terms of the oil find in Ghana. I moved back to Ghana 2 years ago, and prior to that, there had been quite a lot of noise made about how oil was going to enrich Ghana. We're going to be a first world country in 2 years because we had discovered oil. It's obviously not that quick of a transformation. We have budgeted $500 million of revenue to the government for the last 2 years, so 2011 and 2012. And obviously, given the way that these things work, the guys who actually take the risk, so the Tullahs and the Dakas and so on, have to recoup a significant amount of their loss, their cost to drill these wells. And so at this point, we have just for the first year, 2012, recognized significant revenue from oil and gas. Unfortunately, most of this has already been leveraged in terms of funding other infrastructure projects. So it'll be a while before we actually start to see the significant benefit from the oil find. And what's interesting to note is that the oil and gas market is expected to grow quite aggressively over the next couple of years. With each additional oil find, you're looking at a multiple of escalating potential for the oil market. So by 2015, we're looking at potentially a 20 billion market. Ghana's current GDP is about twice that. So at this point, 30% of if you just looked at the pure size of the market, not necessarily the revenue that accrues to the government, but at this point we're looking at 8 billion versus a 35 billion market GDP. by the time this doubles, oil and gas will start to be a much more significant proportion of our GDP. The main areas within the oil and gas sector, upstream, which we think of as the larger international players. In Ghana, it's been Tullow and Cosmos likely driving those. The midstream is the infrastructure that takes the oil from offshore, brings it onto the oil and gas, and brings it into the domestic market. And the downstream are the distributors. We have one of our, I think, very positive establishments for improving the domestic economy is making sure that oil distributed in country is done by indigenous enterprises. So you have bulk distributing companies who essentially take the oil and then distribute it to the marketing companies. So your filling stations, if you would. And given the nature of how these are set up, the key area I want you to focus on is the bottom left. The logos are kind of small, but these are the bulk distributing companies. These are all indigenous players. There were 3 of them 5 years ago, and they've increased to 15. And so these are the companies where there's significant growth potential. They're all indigenous owned, all locally owned, and they're at the stage of growth where many of them are needing to deploy significant amounts of capital to ensure that they can grow in the oil and gas space. For many of them, there's a requirement, so there was previously a requirement that all of them owned their own tank farms. It's since been relaxed, and a tank farm is basically where they store the stockpiles of oil for deployment into the country. That has since been relaxed to 30,000 cubic meters, but it can be a long lease. So someone else can build and own the facility, and they just have to have a long-term contract, so a 10-year minimum contract to essentially operate. These are all high growth. Tank farms will typically run you $15 to $30 million to establish, depending on their size. And so each of them, each of these 15 suggests there's a significant opportunity for investment in the sector. So I'll skip the details on upstream, not because it's not important, but because I think the story has been spelled out quite largely in the media, and it's probably not the simplest place to invest in without the benefit of several hundred millions of capital to deploy. The more interesting things are the midstream and downstream segments. With midstream, the big thing that's happening now is the development of the gas pipeline. So laying out the infrastructure that will bring gas into Ghana. And if you recall, a couple of slides ago, where we looked at the ongoing installment for power, many of those are going to rely on gas to support them. And the government has secured capital to drive this investment, but ultimately there's going to be the associated services that come with the deployment of gas within the country. Most of the service companies are currently not indigenous, and so again, there's opportunity for meaningful investment to the extent that you have the expertise and capital to deploy in that sector. And finally, on the downstream segment, I spoke a bit about the bulk distributing companies. For all 15 of them, with this requirement of building their tank farms and having those operational in order for them to distribute all throughout the market, there's clearly opportunity for investment into these. And as I mentioned, there's 15 of them, there's 4 that already have the capacity. So that means there's at least 9 of them who are either in the process of building or securing capital to do so. With regards to the oil marketing companies who are the actual distributors, so think of a Shell, think of a BP, but in Ghana there are actually 75 of these, many of whom are indigenous. They have fairly wide footprint, very low, relatively per capita expenditure to invest in one of these. So that's another area that's going to drive meaningful opportunity within the market. And I think, as far as just highlighting the key opportunities for investment in oil and gas in Ghana, in line with Home Spring's mission, I think it's largely within the BDC sector and the oil marketing companies. So the indigenous high growth companies that have fairly short turnaround from your capital investment, but also provide a sizable investment that you can, experience meaningful returns from. So I'll end on that note, and then I'm happy to take questions.
Thank you very much, Randolph. At this juncture, we're going to do a bit of a pause and take questions from the floor. We've heard from a mining company and oil and gas and power perspective. I had sort of two suggestions of mine, which I wanted to throw out there. For Timber Resources, my sort of first thinking was around your value chain of processing. Is it possible for investors to have a say or influence at what point in the value chain their financing is directed to? Because I notice there's quite a long line of things that happen between when it's extracted and taken abroad. And then for the Ghana presentation on the power and oil and gas sector, are we going to see perhaps a move in the timeline away from predominantly local companies focusing on the BD side to perhaps focusing on the upstream side? Those are the two questions I wanted to ask. So can we take perhaps 2 or 3 questions in a go? Yeah, the gentleman over there.
Hello, my name is Gavin Tokley with Inno Habitat. We do affordable, sustainable townships. We have an office in Ghana. My question is to the gentleman from the Stanbic Bank. It was an excellent presentation on the power situation. A part of our technology for a sustainable township is the reduction of power in the street lighting. I had the opportunity to speak with the minister a number of years ago to reduce the power. And his reply was, because at the time, power was going out every day, as you mentioned. His reply was that Ghana has plenty of power. It's supplying neighbouring countries and it's got plenty of power. And I said, well, why is the power going out every day? He says that the infrastructure hasn't been upgraded since the 50s, and they turn it off or it would blow up. So maybe you could clarify, is it really that the country needs more power and can handle it, or is there an issue with the grid, or what I'm suggesting is that there's satellite power generation to suit the problem? Thank you.
Thank you, Gavin. Another question? There's a gentleman right at the back on the right.
Good afternoon. My name is Papa Tabara from Senegal, and my question is for Mr. Ecobank. You said that Ghana have problem meeting his requirement for power, and this is the case for most of African countries. And since this morning, we've been talking about drilling. Is it not time to look for other alternatives like investing in power and solar power and wind power to solve this problem that Africa is? Because as we saw, drilling is just a stopgap measure, not a long-term solution. Are you thinking of investing in solar? Thank you.
Thank you. We're actually going to have a presentation from Azuri Technologies on solar energy, so we don't want to really, I mean, you can answer some of it, but perhaps not getting to that so much now. So at this juncture, I wondered whether perhaps you could take the question I posed earlier about the value chain.
The value chain on basically what we're proposing right now, there's a couple of questions that I will want to answer, actually clarify. For basically the investors that put in the money, as you can see, I don't know whether you guys remember the proposed budget, 75 to 80% of those are directly into equipment purchasing. Also, basically they're purchasing new from local Caterpillar. There is not much say that we can really put a value saying if we have actually a couple of investors that we're talking to that they say, why don't you lease the vehicles, lease the equipment instead of buying brand new, or why don't you deal with Caterpillar? Why do you do what you do? There is a proprietary way of what we're doing. We show you the reverse wash plant. That is actually a prototype that we actually developed in Alaska. It will be one of its first kind that we're using with another partner that we're dealing with in Liberia. So the value that we're really dealing with here is pretty much equipment-based. And whether the investor also, another question I would like to address, have a say in the way we extract. So far with my chief operating officer here and the way we've been traveling around the world to look for the best approach for alluvial mining. As he mentioned, it's one of the most misunderstood way of mining. The way that we're extracting, really, there's not much. It's not really hard to do alluvial mining. It's not hard at all. However, there is a way, and every single mine, because of the geological location, and then the gold come from nuggets, flour gold, all that kind of stuff, we really understand exactly what we're doing. So whether the investor have a say, we've been involved in mining for myself about 10 years, for him about 40 years. We'll come to a point where the investor will come in to say, no, this is how you're supposed to do it. But sometimes, because I've seen many cases of that sometimes because the production failed because of that. Technical expertise is actually what we're actually really selling and talking about.
All right, thank you very much. Randolph, do you want to take the question about infrastructure in Ghana and the question about street lightning? Yeah.
Okay, so I'll take your first question about the sort of timeline for BDCs to move upstream. So obviously the key constraint there is capital, availability of capital. You're dealing with companies where their key capital outlay has been something in the tens of millions of dollars to something where it's going to be in the hundreds of millions of dollars. So on their own, it's obviously challenging for them to do. Government policy, though, is recently pushing local content partnerships. So what that will require is that for going forward, for the large international participants to engage in the sector and upstream, they'll have to have some participation from a local partner. And what that means is the BDCs who currently have the expertise and the resources in the space will have the opportunity to partner with these large international players as they do farm outs and sort of acquire new oil fields and so on. There is one particular process that's ongoing with one of the oil fields, TEN, is sort of a test case where there's an opportunity for potentially for indigenous companies to participate in the upstream market. I don't think there's certainly not going to be a rush of them happening, just because even for the small, the requirement is 5%. So even for that 5% requirement, if you're looking at something that's potentially $1 billion development, it's significant capital, and they still need to invest fairly heavily in their core businesses, which is distributing bulk oil into the domestic market. So there is I think with the help of government policy and sort of encouragement of international players, I do see the potential and indeed the realization of the opportunity for BDCs to transition into upstream over time. With regards to the gentleman's question on power, I think that there are two separate issues. One is that, yes, there's an inefficient power distribution network. So depending on who you ask, there's sort of 10 to 30% of power generated is actually wasted, so it's lost in transmission because equipment is fairly old, poorly maintained, and so yes, they do have to, they lose transmission through poor cables. People are tapping, wires, and so they can't manage the actual load on the lines. You think that you're supplying 100 people, but in fact you're supplying 1,000, and so on. So there's that issue with the actual infrastructure. In terms of just pure generation, there is, things have changed quite a lot over the last several years. and demand for power has grown exponentially with urbanization, with sort of Ghana sort of becoming the darling of the continent, or at least the sub-region. There is actually a huge influx of corporate investment into the country, which means there are a lot more companies demanding significant volumes of power from the grid. So there is, in one sense, there is inadequate supply. In the other sense, even the supply that's being provided is not 100% utilized. So I think the work that is going on will, one, increase the availability of power to expand power from just now it's fairly pervasive across the main cities, but increasingly rural electrification is going on. And so to be able to supply across the country and then to our neighbors who don't necessarily have either the same resources to generate power or the capital to deploy into infrastructure, there's the need to expand our power base.
Well, I guess your question is a pricing issue. It's an interesting one, particularly when the population of investors that you're targeting are international institutions. The pricing dynamic is entirely different than when you're dealing with local institutions and local banks. The margin of our Euribor, effectively, we have to have comparables. And the tranche A, which is about 8%, and the senior tranche, basically we look at the risk. And if you look at sovereign risk, Ghana bond 2021 much longer trade at around 600 basis points over the swap curve. Senegal is around 8% of a swap. International investors international funding providers want to be paid for a couple of things. First, this is not really liquid. It's not something that you're going to sell. Second, if you're talking to banks, they want to be paid for capital charge and so on and so forth. And thirdly, you're also in competition with other people who wants to borrow. So the 6% short-term tranche is roughly where, for good quality offtake, short-term receivable, where you will see the price to come. You have to bear in mind, I'm speaking under some bankers' control here, that African banks, for example, the cost of financing in the international, whether it's a loan market, is already around 4.5%. So they need to make some margin. I mean, we track Afrexim, for example, when they do the dollar loan, et cetera, is 3% of our Euribor. So if you add the margin, they need to make a living and so on and so forth. You quickly at 6% for a short term in terms of on lending. The mezzanine piece is very much highly competitive because, generally speaking, it's not subscribed by local institutions because very few institutions in sub-Saharan Africa provide mezzanine, certainly not the commercial banks in sub-Saharan Africa. So your population of investors are international investors, and there you're much, much highly competitive. Investors will ask you, I can get mezzanine risk from MNG in the UK at 12%. Why would I want to go to Africa, in particular in Chad, for 12%? So basically, pricing is driven by the competitive landscape and the portfolio of investors that you are targeting.
Okay. We can take one more question for Francois. Anyone else? No. I actually had a question of my own. I think in some of the structures, financing structures you presented and the sort of the solutions you had for the various types of risks. For an investor, clearly this is an investable, bankable company, but how would you quantify the impact side, being that this is not clearly perhaps directly related to the extractors industry upstream, where you can invest in projects that actually have a social impact, but in terms of quantifying it in terms of the impact, in a country like Chad, how would you present that case?
Well, the developmental impact is key because, first of all, in Chad, the whole oil activities is around N'Djamena. So the southern part of Chad, particularly next to the Sudanese border, the government wants to develop. So part of the financing is to enable this company to build up storage capacity into that part of a country, which will translate into new jobs creation. The second one as well, the second impact is the humanitarian impact in terms of Chad is a hub for quite a number of international organizations, particularly the UN, to provide food in southern Sudan. And also remember that Chad was the place from where the French government was having its aircraft to go to Mali. So the impact is critical in terms of helping. When I make the United Nations World Food Programme, they have a big issue in terms of cost and speed of providing food to Southern Sudan because they can only fly from Jamena. So they want to be in position to fly from Southern Sudan. And the funding that we give into this particular company as part of the expansion is precisely to have storage capacity in the southern part to make it easier for the UN, for example.
Thank you, Francois. We're going to move swiftly to the final presentation, which is by Simon Bransfield-Garth, CEO of Azuri Technologies, who are in the solar and renewable energy business in Africa. Thank you.
Thank you very much. This afternoon, I'd like to present to you an opportunity which is both a financial investment and also a social investment. Azuri is the leading commercial provider of domestic pay-as-you-go solar. In Africa, many people are earning in rural communities perhaps $3 a day, $4 a day. And they find it very difficult to afford the capital cost of buying solar power. So what Azuri has done is to combine mobile phone technology and solar technology so that people are able to pay for their solar power as they use it as a service. And typically, they pay about half the cost of the kerosene and the mobile phone charging it replaces. After 18 months, the customer then owns the piece of equipment and no longer has to pay for their energy. So this is a revolutionary business model that has been successful right across Africa. And Azuri was named as one of 23 global technology pioneers by the World Economic Forum in 2013, and has now deployed something in excess of 22,000 systems, and we've delivered something like 4 million hours of solar light in Africa. So from the customer's point of view, the customer is spending typically about $3.50 per week on a combination of kerosene and mobile phone charging costs. If you were to get electricity out of that wall, you'd be paying about 15 cents per kilowatt hour. If you're burning a kerosene lamp, you're paying about $8 per kilowatt hour. If you're charging your mobile phone for 20 cents, you're paying about $100 per kilowatt hour. So some of the poorest people in the world are not just paying a bit more for their energy, they're paying orders of magnitude more for their energy. And what we want to do is to redress that balance. So what we do is we take advantage of the fact that 60% of the adult population in Africa have mobile phones, and we use mobile phones to enable people to be able to pay for their solar power as they use it. And people get 8 hours of clean solar light every night, and they've got a USB port that they can go and charge their mobile phone, not just for themselves, but also for other people. So this isn't just a case of delivering a piece of solar technology. This is about delivering an end-to-end service model in rural Africa. And that requires extensive back-end technologies. It requires a great deal in the way of distributor support and training. And it requires real-time customer metrics to be able to monitor and track all of those deployments. And that is something that Azuri has put in place. So the market is enormous. There are 600 million off-grid customers in Africa right now, and Africa is the only region in the world where the number of people off-grid is actually growing and will continue to grow up to 2030 because population growth is outstripping the rate of supply of electricity. It's about a $25 billion replacement market for kerosene and mobile phone charging right now. So this isn't a new product into a new market. We know what the existing spend is, and we just need to substitute that spend. And within the ECOWAS region, about 180 million people lack electricity. So what does this do for individuals? We'll talk in a minute about what it does for investors. But on average, our customers extend their productive day by about 3 hours. On average, children spend 2 hours per day extra doing homework as a result of having lighting. And it eliminates a lot of the unpleasant things that come with things like kerosene. So it eliminates the fumes, it eliminates the fire risk, and of course it helps with improving the CO2 burden of the world. So AFWA is a finance vehicle. The way that any kind of pay-as-you-go system works is that a piece of capital equipment is put into the customer's hands and the customer pays back over a period of time. So there is a requirement for working capital in order to fund that deployment of equipment into the customer's hands. AFWA is a finance vehicle to fund the rollout of that technology into the customer's hands in West Africa. And it's a 5-year program seeking to serve 1 million households and bring off-grid energy to those households at a cost which is an absolute fraction of the cost of delivering energy through the grid. The fund is a $6.6 million fund, and that funds the first 2.5 years of deployment of those units. It's roughly 200,000 systems. Once we've deployed those 200,000 systems, we have partners who will then put in place the additional funding to fund that out to 1 million units and take it beyond that. But this isn't a charitable activity. This is a commercial proposition, and we make money, the customer makes money, and the distribution chain makes money. And it's tremendously important that the distribution chain in the country, from end to end, is making money and is invested in deploying this technology. For Azuri, it delivers between 45 and 50% margins. For the end customer, they're saving about 50% on their energy costs from day one. And this is something that rolls out with the dynamics of consumer electronics. It doesn't require permission from government. It doesn't require commercial deals with mobile operators. This is a B2C play and enables the technology to be rolled out in a matter of months. In fact, we were invited to Sierra Leone in March by Kandayum Keller, who runs UNIDO, and also by Sherry Blair. We met President Karoma in Sierra Leone, and by June we were supplying systems into Sierra Leone. It's that fast. So as I mentioned, we've got 3,500 systems deployed today in Sierra Leone, and within Sierra Leone and a variety of other countries within Africa, demand exceeds supply. The limiting factor in the rate of growth of this technology is the availability of working capital to roll the systems out. We have plans for 2013 to have 10,000 systems in Sierra Leone, 4,004 in Togo, and 2,002 in Ghana, and we expect that to grow very rapidly next year. We've proven that this system works. We've had systems working right the way throughout the rainy season in Sierra Leone, and the systems perform extremely well right the way through that period. And we have very well controlled default. We have very small single-digit default rates from our customers. And the reason for that is that if you stop buying the solar power, you go back to spending twice as much as you were on kerosene and on mobile phone charging. In order to make this work, the key thing is you've got to have metrics. Our customers pay for their system using scratch cards. When they get that scratch card, they send an SMS message, which goes to a local number. That goes to our server. That then sends them back a passcode, which they type into the unit, and the unit then works for a week. So we have real-time information about the purchasing characteristics of our customers. We have an SMS touch point with all of our customers once a week. And we're able to develop that into quite detailed analytics to monitor the rollout and effectiveness, not only of the systems with our customers, but also the entire distribution chain that is delivering those systems to those customers. So here's an example. This is in Tombu, which is a fishing village in southern Sierra Leone, just south of Freetown. And what you find is that people use these things for all sorts of things you'd never have thought of. So this is the fishing village, and what the villagers do is they haul the lights up to the top of the mast, and that means they can fish at night as well as fishing during the daytime. This is the sort of things that people are doing when they've got solar power. So there's a series of risks, which I won't go into in great detail. We can talk about those offline, happy to do that. But this is a proven system. This is something that's worked in 10 countries in sub-Saharan Africa, and is something that is being rolled out more and more broadly within the continent. So in terms of the funding, the vehicle is a special purpose vehicle. The reason an SPV is because we want to ensure that the debt funding that goes into that vehicle is used to fund units and only to fund units. So that money can't be used for funding Azuri or funding anything else. It is only used to fund a unit. The economics of a unit are the manufacturing cost is about $60. And that system delivers $110 of revenue over 18 months from the customer. Into the SPV. The 6.6 million funds the first 2.5 years of growth, and then, as I mentioned, we have other mechanisms to extend that growth beyond that. So the debt is structured as a layered vehicle. We have high return mezzanine subordinated debt, which is delivering an IRR of about 21%. And then we have the bulk of the investment is conventional debt, which is delivering a return of around 8 to 10%. The debt is thoroughly over-collateralized. So as I mentioned, the income per unit is about $110. The debt per unit is about $60. So we would need something of the order of 50% customer default before the debt holder saw any kind of shortfall. Right at the moment, we have default of the order of 2%. Is that it? Try again. No, it's just not responding. Keeps going backwards. Okay, fine. So in terms of the team, very experienced management team. I won't go into detail about that. Tom is the chairman of 11 quoted companies, including Northgate, the vehicle rental company in the UK. And we have a series of other senior executives who've been working in related industries for a long time. So AFWA is about delivering aspirations as well as delivering money. And I want you to take a look at this photo. Here we've got a couple of kids with mobile phones, except they haven't got mobile phones. They've got mud mobile phones. What we're going to do is to turn those mud mobile phones into real mobile phones, and we're going to bring energy to rural West Africa. Thank you very much.
Thank you, Simon. I'm now going to open up the floor for questions to Simon and any of the panelists, but we'll prioritize the ones to Simon first of all. So does anyone have questions for Simon? Yeah, okay, the gentleman there.
We didn't talk much about the solar panels. That's what we were just curious to know. How much do they cost? Where are they manufactured? And what are the maintenance costs of having them? The other question was to Timber Resources, the representative. I mean, the World Bank showed that gold mining companies in Africa, particularly like, say, Ghana, since independence, have not really paid their full due of taxes. They've only paid about 1/3 of their taxes to the government, and that's the main source of loss of revenue for the government, along with other things like corruption and capital flight, underpayment of taxes, and lack of proper producer prices for its resources. So I just want to know if Timber are paying the correct agreed taxes to the government, as many companies don't, and they deny they've got the stores of gold that they've actually maintained. They deny they've got them. They say that their operations are much less profitable than they actually are. And the other question was to the Stanbic representative. The BDCs, what kind of investment can be available for small investors? Is it through home strings or directly?
Thank you. Can I please ask you to, we're trying to get as many questions in, so just one question, short question. I'm going to take another two. Who has a question? There's a hand in the back there on the right. Yeah.
Right. I'm just trying to get you right. Are we allowed to ask questions across the board or just one person? Okay. Oh, yeah, that's cool. Thanks. With Timbo Resources, I was wondering, do you have stock market? Are you present on the stock market? Are you planning to, or would it not be more efficient to raise the kind of monies you're talking about for the project on the stock market? That's for the Timbo Resources.
Thank you.
Azuri.
Just one, sorry. Sorry, we want to get more hands in because we're running out of time. There's a gentleman in glasses here in the middle.
Hi, I'm Papa Tabara. My question is for Simon. Simon, I'm very impressed with your project, solar project. It's just the payment method when you say people gonna pay by mobile phone. If you consider in the rural developed area, people have no bank account. How they gonna pay with that? Do you plan to install some shop or they can top up for the energy for the system?
Okay, thank you. And the last one in glasses?
My name is Dagbo Adeleke. My question is for Simon. During your presentation, you said that you wouldn't really want to go into the risk aspect of it, but we would definitely like to know what the risks are involved, please.
Thank you. I think, Simon, I'm just going to actually ask you one. I mean, you gave such a compelling case. I was thinking, if this is going to be 50% of the cost of other forms, why haven't the government, caught on to this? I know you said you don't need government's permission, but surely you still need the environment and the supportive infrastructure for this concept, don't you? Yeah.
Okay, so I've got 4 questions there. I'll try and do them quickly. So in terms of the solar panel costs, we're not providing a solar panel. We're providing a complete solar home system. So it's a combination of a panel, batteries, electronics, lighting, mobile phone charging, the whole thing. The manufacturing cost of that system is about $60, and as I say, it's then paid for in weekly increments. In terms of the way the payment is done, there's 2 ways that can be done. One way of doing that is by purchasing scratch cards as a retail item, and those scratch cards are then validated just using an ordinary mobile phone over SMS, or where mobile payment exists, like M-Pesa or similar payment systems, then we use mobile payment. So you don't have to have mobile payment in place, but if you've got mobile payment infrastructure, then great, that works just fine. In terms of the risks, the major risk is that for some reason the customer doesn't pay. So the system is deployed, there's a piece of capital equipment in the customer's premises, and the customer doesn't pay back. And that is dealt with really in 2 ways. The first one is that the customer is economically incentivized to carry on paying simply because the cost of the alternative is more expensive. The second one is that we work very closely with local communities to do the distribution of these products, and therefore the whole local community is invested in the individual customers continuing to pay. So if I give you an example, in Tombu in Sierra Leone, the person who is the main scratch card distributor also runs the Fishermen's Union. He's a guy with respect and responsibility in the community. And so people feel a sense of trust, but also they feel a sense of obligation to carry on paying to something that they've committed to. So we find that the default rates on payments are very low. We do have customers who have agricultural incomes who have varying income. So sometimes you've got money, sometimes you don't have money. And so you have people who maybe have a gap in their payments for a week or 2, and that's absolutely fine. And one of the beauties of the system is it enables people to be able to pay intermittently in order to get their power. As far as governments are concerned, it's a good question. A lot of governments are still very fixated with the idea of grid power and centralized generation and rolling power out. And I think the idea of distributed power is still something that is very new to many places. But it's absolutely clear that for $50 or $100 of capital equipment put into the customer's house, you get vastly more benefit in a rural environment than you do by putting that $50 or $100 into the equivalent supply of grid electricity into those communities.
Thank you very much. Timbo, did you want to address a question on taxes and the stock market?
Yes. Okay, so to address that gentleman's question on taxes and whether we'll store gold and not pay taxes to the government. Basically, the answer is actually beneficial for us to pay taxes. The reason why is that, number one, we're in alluvial mining. So the bars and the gold bars that actually was smelted out of our system or our facility is not pure gold. We do not have a processing mill like the hard rock mines do. We do not have that. We basically melted whatever we can get off the ground. It might be 93% gold, 92%. So it is number one for us to be incentivized to actually send it over to a refinery and have them deposit the funds directly into the company account. I think that's number one. It's the best way. Number two, it's security issues. Because, like we said, we're alluvial mining. We're not building, like we said, we're building a 5-acre facility compound, which is fairly small compared to those big gold companies. The incentive is this. Why do we have, we haven't explained this, but basically what we're saying is every 2 or 3 days, we'll have our own airplane fly into the facility. Probably by our estimate, we're looking at maybe less than $500,000 worth of gold, fly straight into the international airport, have the security of the government actually took over the taxes and the gold bars, and then have commercial airplane from Europe, one of those refineries, come in and actually secure it for us. We do not want to store more gold than it's necessary because, number one, security issues, and number two, theft. There's so many issues why we're not paying taxes. And for the license that we're getting in Liberia, every single gold bar export taxes is only 3%. So for accountability, why not? Why we're trying to avoid taxes in that instant? As for raising money in the stock market, our company is private, very simple ownership. We have no debt so far. Everything has come out our own pocket. So we have no other ownership other than him and myself. So why would we want to dilute and go into the stock market? That's number one. Number two, whoever the investor, this is actually because we've been working on the ground for 3.5 years. This is actually the second forum that we're actually trying to present to raise money. We haven't tried to raise money before. So it is actually for the investor a very good opportunity at this point of time to get in with us on the ground up. And like I said, ordering equipment, going have it deal with Caterpillar, and the only company that we want to deal with because of their servicing, their warranties, and also availability of parts around the world. It's a lot easier. By ordering that, it will take about 3 to 4 months for actually the equipment to arrive. So why were we not waiting for something perfectly set up for us instead of trying to go to the stock market and maybe do this, maybe dilute ownership of investors further, things like that? I don't think that's a wise move for us.
Okay, good. There was a question on BDCs for Standard Bank.
So I think the question was how a small investor can participate in the BDC story. Yeah. Okay. So I guess the question is, the reverse question is how small. For an institutional investor or a meaningfully capitalized investor, a direct, we can easily facilitate direct introductions to provide capital for infrastructure projects, so for building out tank farms and so on. If it's a much smaller ticket, I think it'll be, to be honest, it'll be challenging to do. There's obviously opportunities where there's a $5,000 check and so on. Obviously, HomeSpring probably provides the best avenue to access much smaller tickets for investment in these opportunities. So we'll look to leverage those. But I think it's better, it's easier to look at bigger checks. But that said, obviously, there's a reason we're here to leverage HomeSpring, so we'll do that.
Do we have any more questions? Do we have time for any more questions, Eric? No? 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 Oh, is that it? Yeah? Okay. All right. Sorry. I actually had a couple of things. Just sort of reflecting on the panel and thinking back to Azuri Technologies. I was quite interested around the patents for these types of technologies. They're things that can be scalable through your company, but in terms of competition coming from inside, perhaps, I don't know whether you could perhaps shed a bit of light on what part of this technology holds the patent and what is the risk that someone could copy this? And is that necessarily a bad thing in Africa?
Yeah. So the technology that we are rolling out has IP in it. Very little of it is actually in the form of patents. Really what we're doing is we're bringing a new business model into Africa. And so in the same way as you look at FedEx or you look at MasterCard and you say, well, the concept is trivial, but the execution is difficult. Well, that's exactly the same thing with this. Delivering last mile distribution at scale in Africa is difficult. Sorting out finance for large volume B2C plays in Africa is also difficult. And providing that back-end data and the back-end information systems that underpin the risk management of the entire package, that is something that is not found, we believe, anywhere else. So bringing all those together, that's the core of the Azuri proposition.
Thank you very much. I'm sure you'll join me in thanking the panel. I think it's been really informative and insightful. And to some extent, all of these industries actually intertwine. These guys need power for their operations, and we need to move to more sustainable forms of energy as well. I'm now going to invite Leon from DMA to give some remarks before lunch.
Good afternoon. Don't worry, I'm not going to detain you long, but this is all for your benefit. So these are just a few logistical things. As you know, we're running a little bit behind, but I think that's because we've been also stimulated so much that we've just asked question after question. So can I suggest that we aim to be back at 2:45, if that's okay? So don't all rush out just yet, but just to say, clearly, we've only heard a snapshot of what all of these ladies and gentlemen have presented this morning. We have a lot more cases this afternoon. So please use this time to really quiz the people who've presented their ideas. That's why they came. That's why you came. So I probably don't need to say that, but please make sure you use the time in the queue that there's bound to be for lunch to get more information. Secondly, if you want more information, there's at least two sources apart from talking face-to-face with a person. There are a number of stands outside. All of those stands have handouts about the specific opportunities here. Obviously, there's even more detail on the HomeStrings website, so please go onto that. The final thing to say is that all of the presentations, videos, information will be available on the HomeStrings website by Friday, and we will email all of you, so hopefully we've got a valid email address to let you know when they're up there. So please enjoy your lunch, mingle, make as much noise as you like, and we'll see you back here at 2:45.